contrarian, leave it to contrarian badass Reggie Middleton. He called the housing crash. He called the collapse of Bear Stearns and Lehman Brothers and the crisis in the Eurozone banking system.
Reggie Middleton.
I'm at the Consensus 2017 blockchain conference, I guess you call it. Interesting. I didn't get a chance to do a video of the crowd, but we have several thousand people here. Many of the Fortune 500, Toyota, IBM, Accenture, Deloitte, Consulting, Microsoft, very thick. So without a shadow of a doubt, the blockchain technology has fully embedded itself into the fabric and rubric of, global industry, not just finance and technology. And on that note, we have 3 days left to our token offering, which is coming along very well. I did not pre-sell it, pre-market it with any other channel besides moi and the Veritaseum resources. Despite that, we did very well. I'm not going to announce how much we generated, because this is not about how much that will come from a token sale. It should be how much value is generated. So what would we do and what would we produce in terms of revenues, in terms of margins, in terms of profits, in terms of market share, and in terms of furthering the economic interests of our stakeholders, which are those who use Veritaseum. Okay, this is going to be some very, very cool stuff. We released Gnosis, the forensic valuation, yesterday. It's a 20 to 23 page report, full financial analysis, full forensic examination. We varied the tokens according to various scenarios. We also we analyzed and valued the economic operations of the company, EBITDA, the whole nine. These are terms you don't even hear in this space. We gave the Gnosis report away for free to show where the bar should be set in terms of reporting and analysis for these companies. We have Augur ready to go. I'm not going to release Augur until after the token offerings ended in roughly 3 days. Next up after that is Ripple. Okay, and we've already started Ripple. I have 2 analysts full time with a third coming on very soon. All they do, 21 man hours per week, is is that right? 24 man hours per week. Ripple up next for forensic analysis. Ripple is a much longer standing operating company with much more traction than than those that we've done thus far, which are basically nascent startups. Okay, the CEO of Ripple, I talked to him in depth here. He's agreed to give a full interview and answer our Q&A. Of course, that has no bearing on our independent analysis. We just want his input, which is definitely appreciated. And we are also doing Dash. I personally sat down and did like a 20-minute Q&A with the Dash CEO. And the analysts are pulling together their findings on the Dash model, etc. We're going to go back to both Ripple and Dash to have our tech guys and the financial analysis ask them questions and pick apart the business. This is all very exciting. This is all this will be delivered within a month. The only way to access it will be through Veritas. Okay? The only way. If you don't have Veritas, if you don't have our tokens, you're speaking to us. Okay? You can't access fiat, etc. On top of that, we're really delivering. We're really working. We will have an alpha of the first financial machine, which should be spinning up later this week, very quickly. Remember, I told you to expect finished software at the end of 2018. We're having tidbits coming up very soon. Once we have the GUI, because it's command line driven now, so it's definitely, not for lightweight to beginners. So once we have the GUI together, we're going to start doing limited beta tests. So I will be inviting those Veritas holders who are willing to gamble up to $200 worth of their Veritas to participate in this with the potential for a full and complete loss. Remember, this is a beta. We will test this on iterations, and we're not going to repeat the Dow debacle from last year. So test 20,000 limit, 40,000 limit, 60,000, 100, 200,000, until we're confident that we've taken the bugs out, the usability issues, and it's relatively stable and safe. Then we lift the cap off, okay, or put a very high cap on. and we're off to the races with a synthetic machine-operated simulacrum of what some people call a hedge fund. Okay, lots of exciting things going down the pike. We are actively hiring. I need business dev and marketing guys. Business dev, marketing, sale. I need that now. I need strong engineers, strong architects, strong developers. Okay, preferably if you know Solidity, but it has come to my attention that there's a much larger pool of applicants who don't know Solidity than there are that do know Solidity that can operate at the level that we need. Okay? Software architects, software engineers, software developers. We're also looking for quants and financial engineers. We're also looking for business dev guys, and gals, of course, marketers, and salespeople. So come at us, and as a little sneak preview, let's cut over to what the CEO of Dash said. I was actually quite impressed with what he had to say. A true businessman, a smart dude, and a mature guy, a grown up. Okay, and if you don't forget, in our risk-adjusted reward analysis, Dash had the highest risk-adjusted reward of all the cryptocurrencies. As a matter of fact, of all the financial assets that we've ever valued. I'm going to let you get a quick listen as to why the CEO of Dash finds that to be so.
I'm Ryan Taylor. I'm the CEO of the Dash core team, which is one of the teams that services the Dash network and does the primary development and promotion of our solutions.
Okay, and we're at the Consensus 2017 event, and I just walked by his booth and asked him if he'd be interested in giving his any information for management. And in walking through here, I gave him a tidbit of information. Anybody who follows our risk-adjusted return analysis for tokens knows that Dash has the highest risk-adjusted return of all the major crypto tokens that we know of. And we went through a quick layman's definition of the risk-adjusted return. He actually is very well versed in the mathematics behind it, kurtosis and everything else. So we measure risk not as standard deviation or deviation from mean or expected return, because that captures volatility in its raw forms, which includes upside. Now, if you're a long-only investor, you want as much upside movement as possible, regardless of how staccato or erratic it may be. So we measure risk as downside movement only. Okay, and we filter up upside. That downside movement is considered the risk component, very similar to the Sortino ratio, which is finance babble, forget it. Okay. Now, with Dash having the highest risk-adjusted return of Bitcoin, Ethereum, etc., that's significant. It doesn't have the same raw upside, but it's also considerably newer than Bitcoin. But very, very hedge funds. So, with that being said, I'm going to have him give his quick spiel, and then I'm going to put my analyst on audio and have him ask him a few questions, which of course won't be privy to this video, but our report will have the full analysis and output of the Q&A. So the floor is yours. Anything you want to tell? Maybe it'd be good to introduce. I'm known for calling big moves. I called the fall of Bear Stearns and Lehman Brothers, Research in Motion, which is now BlackBerry, the European debt crisis, AIG, I missed AIG, I'm sorry, the housing bubble, CRE, etc. So I'm good at macro moves, I'm strong on technology, and I have my own way of doing things. So I've moved full sail over into the crypto land, stopped the advisory visits. We're doing our own token offering, etc. Heavily concentrated on value transfer. And that's where we came across Dash. So, all right. That's who you're talking to.
First of all, thank you. But I was very pleasantly surprised to hear your analysis and hear that we actually came out on top of the rankings on that dimension. It wasn't entirely surprising to me to hear that, and I do have some hypotheses on why that might be the case and why it might continue to be the case. First of all, I think that addressing what causes volatility in the first place. I think there's a lot of speculation within the space on what the potential winners could be coming out of this Cambrian explosion we've experienced over the last few years of different tokens starting to take market share and so forth. And oftentimes you see big market moves from changes that don't make a lot of sense. Either a new technology is introduced that doesn't have as much of a practical use as it is kind of hype. You see a lot of reaction from the market in terms of movements themselves. So when an asset is going up in value, other people try to get on board. I think that's partly an issue of people not being educated enough and not having enough of an understanding of the space and how it's likely to evolve. It's a new space, and so a lot of people are learning about it for the first time. And so they just know what goes up and they try to buy those things. But that works in reverse. And when people are selling and prices are going down, people are trampling each other to get out the door fast or out first. And so that causes a lot of volatility within the space. And when you look at the type of investors that we have and the system that we have set up, we've got a unique attribute or a unique technology built into our platform called masternodes. And masternodes serve a useful purpose. They service the network. They provide specific services like our instant send feature, privacy features. They administer our governance model that we have in place. They provide a number of different services to the network. And a prerequisite in order to start one of these masternodes is the 1000 dash. And those masternode owners, once they achieve that investment, are very proud of that, I think. And they have a real stake in the outcome of the coin, and they have a voice in terms of their vote and real control over the situation. And all of those things combine to, I think, make masternode owners far less willing to run for the exits when we're having a bad week or what have you, relative to these other assets. And so people they receive a masternode reward about once a week. Why they would want to sell partway through the week, their asset that they've worked their way towards their next masternode reward. There's a certain pride in everything that comes with it. And so people are willing to be much more rational in the short term and not cause these panic selling sessions. And so I think that's part of the reason. I think also you've got a lot of people on the sidelines who would like to become a masternode owner and have begun investing. And when the price falls, they view it as an opportunity, not a threat. It's an opportunity to build further towards that masternode, and you see people come in with capital in order to build their way up to that next masternode. And so I think this collateralization of nodes serves more than just the intended purpose. It also helps stabilize the market. And it's allowed us to achieve a level of stability that at a much smaller scale than Bitcoin was able to achieve the same stability. I think that it was just 12 months ago that Bitcoin was kind of hitting the numbers that we had hit by fourth quarter of last year in terms of volatility. And so it's a very stable coin, it's a steady grower. We do avoid any type of hype. We're very quiet. We're out pursuing business deals and trying to sign up new partners.
Trying to make money, really?
And trying to provide a useful service to the market, and that takes time. And so we don't pre-announce things. We don't,
I have to. My analyst is actually waiting in a very far away time zone. I do want to add one comment, and I was telling her I'm very objective, so I'm not. There's a strong chance, or at least a 50-50 chance, that this may not come out as complimentary as you want it to be. But it's math. 1 + 1 = 2. If you have an issue, I'd suggest you take it up with the operand and not, with us itself. But one of the causes of volatility is the desire for the entities behind coins that we've seen to attempt to achieve price appreciation through supply-demand manipulation versus creation of value. It is a very good thing for me to hear that you're out soliciting business versus marketing, trying to push the price of the coin up. I'm not as familiar with Dash as I should be, but I will be within a week and a half, so trust me. But I noticed that a lot of entities put out a relatively small float, and that's how you manipulate the demand by limiting supply. The way we're attempting to do it with our concern is we increase actual value, and actual value then increases the price relative to supply.
Yes, there are some coins that have a relatively small amount free floating, and so that affects their market cap, because a very small amount is available to the market, and a lot of capital chasing that small amount. But what I don't think people are taking into full account is what happens when the rest of those coins become available to the market. That could be a pretty serious situation for initial investors, and certainly from a volatility standpoint.
Right.
But I do believe that the projects that are seeking out real-world use cases and developing a technology to address those things and developing techniques in order to go after those markets are going to do much better over the long haul than ones who are introducing technology for technology's sake and asking, well, what are the cool things we could do with it? And so I think we've got the right approach in mind. We're business-led rather than, what are the limitations of the technology-led, and we're solving for real use cases. And that's a very different mentality, and it causes you to go about your work in a very different way. And I think that is the approach that's going to prevail in the long run.
Okay, sounds good. We just to let you know, I personally developed the valuation framework. There's 3 levels: layer 1, layer 2, layer 3. Most pundits in the space value the entities by taking tokens available and multiplying it by price. They call it market cap. That is absolutely irrelevant for our perspective. Layer 1 is a platform where you have the vast majority of economic value does come from the token. Most of these entities attempt to run at break even or very, very slight profit, but no economic profit, because their return comes from price appreciation of the token. But on top of that, you have layer 2, which are communities and templates, where they get to charge for services that may be open source, but many entities wouldn't want to get their hands dirty doing. Think of Ethereum, and then think of Consensus on top of it, even though they're 2 different entities, just to give you an example of how it would look. And then level 3 would be bespoke applications, prepackaged applications ready to sell. Level 2 and level 3 give actual EBITDA, earnings, expenses, etc. Level 1 is very difficult for those who are not in the crypto space to understand in terms of, profit and loss. And those who are in the crypto space understand the technology, but don't necessarily go through the economic valuation. So we meld all 3, and that's how we value an entity. It's very good to hear you say that even